There is something uncomfortable sitting at the center of BP's March rally. The stock climbed 24.5% in a single month, one of the FTSE 100's strongest individual performances. Oil prices rose, and BP benefited. That is the surface-level story. But the surface-level story has a problem. The last time oil prices were this high was 2022, and in 2022, BP missed it entirely. That is not a small footnote. It is the central tension of this company's recent history. In 2022, while Shell and other oil majors were converting high crude prices into substantial earnings, BP was deep into an offshore wind build-out. The timing could not have been worse. Inflation surged, interest rates climbed, the economics of renewable projects deteriorated sharply. BP absorbed large losses at precisely the moment its rivals were printing cash. Then, by the time BP reversed course and recommitted to hydrocarbons, the oil price cycle had already turned lower. 3 years of misalignment, one badly timed strategic bet. That is the context behind March's 24.5% gain. Now step back and look at where BP stands today. Under new CEO Meg O'Neill, the company has pivoted firmly back toward oil and gas. The offshore wind ambitions have been scaled back. Capital is flowing toward the core hydrocarbon business. The strategic messaging is clear. BP intends to focus on what it actually knows how to do. That framing matters more than it sounds. Oil companies that stray into renewables face a structural disadvantage. They are competing against utilities, infrastructure funds, and specialist developers who have spent decades building expertise in that space. BP's genuine edge is in upstream exploration, reservoir engineering, and large-scale hydrocarbon logistics. Returning to that core is not a retreat. It is a recalibration toward competitive advantage. Shell, meanwhile, has been executing a version of this same logic for longer. The daily share buyback program, extended again in late March, purchasing shares across both London and Amsterdam, reflects a capital return discipline that BP is still working to rebuild. Shell's approach has been quieter, less dramatic, and arguably more consistent. That consistency is now showing in how the two companies sit relative to each other in analyst coverage. BP recently received an analyst upgrade to overweight, with a price target raised to $49.40. That is a signal from institutional coverage that the directional shift is being taken seriously. At the same time, Venezuela is back in the conversation for Shell. A potential oil deal there could add production optionality at a moment when supply geography is becoming a geopolitical variable again. Here is the point that tends to get missed in the BP versus Shell comparison.
When a stock spends years underperforming, the embedded expectations reset lower. Valuation multiples compress. Institutional positioning thins out. And when the operational story starts to genuinely improve, not just cyclically, but structurally, the re-rating can happen faster and from a lower base than it would for a company that never fell out of favor. BP's long period of being in the wrong place at the wrong time has paradoxically created room for a sharper recovery if the strategy holds. Shell does not have that same re-rating potential. It has been doing the right things for longer, so the market already prices in a higher degree of execution credibility. BP's upside is partially a function of how badly it got things wrong. The broader backdrop amplifies all of this. UK Prime Minister meetings with Shell, HSBC, and Goldman Sachs on Iran war energy crisis dynamics suggest that the geopolitical energy environment is not stabilizing, it is escalating. When energy policy discussions happen at that level of government corporate urgency, supply risk premiums tend to stay elevated. That is a tailwind for both BP and Shell, but it does not affect them equally. BP is running a catch-up operation against a backdrop of favorable commodity conditions. If oil prices hold or move higher, the new strategy gets the benefit of timing for the first time in years. If prices fall, BP's reset has less margin for error than Shell's, because Shell is further along in its capital efficiency journey. The divergence in capital allocation is the real story here, not the share price moves. Shell is returning capital systematically through buybacks, while BP is still in the process of rebuilding credibility with the same investor base it frustrated through the wind farm era. That rebuilding takes time. Analyst upgrades help, but the proof will need to come through in reported earnings over multiple quarters, not in a single month's oil price rally. Evidence leans towards BP's strategic reset being genuine rather than cosmetic, but the recovery is conditional on two things holding simultaneously: oil prices remaining supportive and management executing on hydrocarbon-focused capital allocation without reverting to diversification under pressure. If both conditions hold, the valuation gap between BP and Shell has room to close. If either breaks, BP's recovery narrative is still fragile enough to unwind quickly. Shell, for its part, does not need oil prices to surge in order to justify its current positioning. The buyback discipline and operational consistency mean it is more insulated from commodity volatility, but that also means its ceiling in a high oil price environment is somewhat lower than BP's. Two companies, same industry, same geography, but fundamentally different points on the same arc, one that runs from strategic conviction through execution failure and back toward credibility. Where exactly BP sits on that arc by the time the next earnings cycle lands will determine whether March's 24.5 was the beginning of something or simply a commodity-driven echo.